Over the past 10 years, Main Street Capital's total return is just a smidgen ahead of the S&P 500. Plus it's paying a dividend of 6.9%, along with some special bonus dividends that we'll get to shortly. Over the past 5 years, Main Street Capital has a much clearer lead over the S&P 500. And then more recently, over the last 12 months, well, the S&P 500 has lost 5%, while Main Street Capital continues to pay its yield of 6.9%, and it's actually gained 8%. Hi from Khao Lak in Thailand, and I hope you enjoy the change of scenery. Main Street Capital has a reputation as one of the most reliable business development companies, but it does pay a lower dividend than competitors like ARCC. Today we'll look at why it's so popular and whether it's still worth considering despite that lower yield. A quick disclaimer, I'm not a financial advisor, I'm just a retired investor sharing the research I do for my portfolio. I make these videos to help you decide which investments you want to research. Let's start with the dividends. The 6.9% yield is nothing to write home about, but there are two factors behind that number that make Main Street Capital's dividend exceptional. The first one is consistency, and I typically use Seeking Alpha's charts to look at dividend history, but in this case it's not the clearest chart. Those initial payouts look higher because originally the payouts were quarterly, then they switched to monthly. Also, there's a lot of extra lines between the lines, and we'll get to those shortly. This chart provided by Main Street Capital presents it in a much clearer way because each line represents the average dividend from the previous 12 months. To a dividend investor, this chart is a thing of beauty because no dividend cuts and too many dividend increases to count. During the 2008 recession and the 2020 pandemic, investors were fearful that there would be a lot of defaults from Main Street Capital's borrowers. And as a result, the stock price did take a substantial hit on both of those occasions. But despite those challenges, this dividend machine kept spitting out dividends month after month with perfect consistency. And as a dividend investor, that's exactly what I want to see. This consistency doesn't happen by chance, and we'll get to how they do it shortly. So the 6.9% yield isn't just any old yield, it's a yield with a solid history behind it. The second factor that makes Main Street Capital's yield exceptional are those additional lines that I mentioned earlier. These are supplemental or special dividends. If income is higher than expected, then a business development company can issue a special or supplemental dividend above and beyond the regular dividend. There's no promise or expectation that the supplemental dividend will be repeated. It's a bonus. That dividend chart with the smooth dividend payments that I showed you earlier doesn't actually include supplemental dividends, but this chart does. Those green lines are the supplemental dividends, and there's a lot of green lines for Main Street, more than I've seen for other business development companies. The supplemental dividends began in 2013, and then they continued every year until the pandemic caused them to be paused for 3 quarters. What's interesting is that those supplemental dividends are not counted as part of the yield. So for example, if you held Main during the year 2022, at the end of the year, the yield was 7.06%. But when you add the supplemental dividends for the year, which added up to 35 cents, then the actual dividend paid was 8.01%. So far in 2023, Main has announced a supplemental dividend of 17.5 cents for the first quarter. If we assume no change whatsoever to the stock price, which as I record this is $39.17, and no change to the regular dividend, and no change to that supplemental dividend, that it remains at 17.5 cents every quarter for the remainder of this year, then the regular dividend at the end of the year would remain the same, 6.89%, but the actual yield, including the supplemental dividends for the end of 2023, would turn out to be 8.68%. Now, of course, there's no guarantee that Main Street will continue to pay these supplemental dividends for the remainder of 2023, but they did say in their last earnings call that they intend to issue a supplemental dividend in June of 2023. So far, so good. Regarding tax treatment, it's mostly ordinary income. For example, last year in 2022, it was 89% ordinary income and 11% qualified. And if you're a non-US taxpayer, well then 43% for 2022 was exempt from tax. And that's because non-US taxpayers are exempt from tax on capital gains and interest. Nice. Let's take a look at how Main Street Capital makes money. They are a business development company, which is a structure that I explained in the ARCC video. The short version is they act as a hybrid between a bank and venture capital. They lend money to medium-sized private companies, and they have a lot of flexibility as to how they structure those loans. And unlike a bank, they can take some of the payments in the form of equity. In other words, owning a piece of the borrower's business. Revenue streams for Main Street can be broken down into 4 categories. The first one is interest payments and loan origination fees, and that's pretty similar to a bank. The second revenue stream is dividends. Some of these private companies issue dividends just like public companies do, and that's an income source for Main Street. The third revenue stream is equity gains, and that occurs when Main Street sells their equity positions for a profit. And this particular revenue stream gives Main Street more flexibility than most BDCs, which we'll get to shortly. And last but not least, the fourth revenue stream is management fees. Main Street offers its management and its loan strategies to other funds for a fee. Management fees generated $22.3 million of net investment income for Main Street during 2022. So it's been a great way to leverage the Main Street brand. Here's my bull case for Main Street Capital. These are the strengths that set it apart from the competition. This pie chart has so many colors it looks like a paint color wheel. In 2022, Main Street lent to 194 companies in more than 33 different industries. Clearly, that's plenty of diversification, which reduces concentration risk. And I'll include a link to these charts in the description. There are pros and cons to rising interest rates if you're a business development company. One of the advantages is a widening of the spread between the cost of capital and interest income. In other words, a fatter profit margin. Now, this benefit isn't unique to Main Street. Other BDCs like ARCC also benefit from this increasing spread. But the formula for Main Street works like this. For each additional 1% increase in interest rates, Main Street earns an additional 21 cents of net investment income per share. And that's because 70% of the debt owed by Main Street is fixed, while 73% of the debt that Main Street Capital has lent out to its customers is floating. So the distance between those two is expanding. Main Street's conservative approach was evident on their last earnings call. There were 2 comments in particular from the CEO, Dwayne Hyzak, that caught my attention. He co-founded the company more than 20 years ago. The first one was just after the 40-minute mark in the call, and it was about buying opportunities during an economic downturn.
We also want to make sure that when the market is most attractive, which is when no one else has capital, that we can be on offense. You've seen us do that, through each of the big step backs in the economy, whether it was the Great Recession or more recently here during COVID. And if you look at some of the best performing companies, specifically on the low middle market side that we touched on earlier in response to some of the other questions, several of those investments were made right in the middle of COVID, and we wouldn't have been able to do that had we not had our very conservative capital structure and significant liquidity position.
I like that. And then the second comment was about dialing back the supplemental dividend to put aside some cash for the next recession.
We exceeded the monthly dividend by a very wide margin. I think it was 37 cents off the top of my head, and we paid out about half of that, a little bit less than half of that in the supplemental. So that's the approach we've taken the last couple of quarters. I think we'll continue to take that conservative approach, and the reason we're not paying out more is though, even though we feel really good about the portfolio and it's performing at a super high level, there is additional risk in the economy, and we think it's prudent to reserve some of that just in case things take a step back.
I like that too. Main Street has more equity in its deals than most other BDCs, and frankly that could go either way. But so far, it's been working out quite well in 2 ways. First of all, they've picked businesses or borrowers that have on average grown in value, and that's what pays for the supplemental dividends. Secondly, BDCs are required to pay out 90% of their profits to shareholders. And for most BDCs, that's just cash flowing from borrowers to the BDC to the shareholders. But when it comes to equity appreciation, management has some discretion about the timing of when they realize those gains. And to a large extent, that's how Main Street Capital is able to create that smooth dividend chart that I showed you earlier. Those dividends didn't happen to just go up slightly each year by chance. They put aside some of those equity gains, and then when the market crashed, they used some of those reserves to supplement the ordinary dividend. That long-term consistency makes the stock more desirable, which pushes the stock price up relative to other BDCs. And in turn, that higher stock price allows management to issue more shares, which then gives them capital which they can use to grow the business further. You can't read too much into insider trades because people buy and sell their stock for many different reasons. But when I see a chart that's overwhelmingly on the buy side, like this one, I take that as a plus. Main Street Capital's profitability is aided by a relatively low management cost structure. It's managed internally, so that saves on external management fees, and they use share-based compensation to further lower their cost. Now, I wasn't able to find an independent study of BDC cost structures, so I'll have to rely on Main Street's numbers, but this chart shows that relative to other BDCs, they have lower management costs and also relative to commercial banks. And at a cost of less than 1.5% of assets, that does compare favorably with the range quoted by this Motley Fool article. And here's my bear case for Main Street Capital, or potential weaknesses. Rising interest rates are a double-edged sword. They do help increase profits for BDCs, as I mentioned before, but if they get too high, then things start to break. And for that reason, as interest rates continue to increase, we'll have to keep an eye on default rates. Main Street has more exposure to equity than other BDCs. And generally, equity is riskier than debt, as shareholders are last in line to get paid if a borrower goes under. The trick is to be able to select borrowers that are still capable of paying their debts during a recession, and so far Main Street has demonstrated that it's capable of doing that. The number one criticism of Main Street is great company, but too expensive. Specifically, it trades at almost 1.5 times its net asset value. And on that basis, it is the most expensive BDC as shown in this chart. And that's not really a criticism of management or of the business model. It's really just saying that the market rarely offers a great price for this stock. So what is a good price for Main Street Capital? In my opinion, and it's just an opinion, that would be any time that the yield gets above 8% or the price to NAV ratio gets down to 1.3. Any other BDC would still be fairly expensive at those levels, but I think that Main Street Capital is entitled to some premium. My take on Main Street Capital is that it's rarely going to be priced at the level that we really want, but that's for good reason. They have a long history of creating value and of overcoming economic adversity. I don't currently own the stock, but that's just because as a retiree, I'm looking for higher yields and faster rates of dividend growth. But I would pick up a small amount for just diversification purposes, because we've seen over the last 12 months that the price of Main Street doesn't move in lockstep with the overall market. And there's some value to that. Now, having said all that, if the market undergoes a major correction, then I would be interested in picking up a full allocation. And frankly, I regret not doing that during the 2020 pandemic. And that wraps it up for Main Street Capital. More armchair income coming soon. These are the strengths